Hello, good morning and welcome to Business 101. My name is Blyden Kem. On Business 101, we look at some critical details around the world of business, especially regarding policies. On Business 101 today, it wouldn't just be about policies, it would be about the impact of Nigeria's policy as a fish indicates projection regarding a growth rate in sub-Saharan Africa and Nigeria. We'll also look at other predictions and growth rate indices according to quarters economies. But let's talk about it from a fish point of view, as fish quotes Africa growth to 4.2%, on US-Iran clash, Nigeria GDP to 4.4%. We'll begin there. A drawn-out US-Iran conflict in the Middle East is alerting economic outlooks for sub-Saharan Africa, prompting a fish solution to lower the region's 2026 growth forecast to 4.2% from 4.3%. The firm warns of heightened inflation rates, especially in Nigeria, where prices could average 15.5%, up sharply from 12.3%. A fish update assumes the conflict stretches through April, disrupting oil supplies via the Strait of Hormuz and pushing Brent crude to $78 per barrel on average this year from $70 previously. This exposes the region's sensitivity to energy shocks and trade disruption. Nigeria stands out with a nuanced focus. GDP growth runs up to 4.4% from 4.3%, thanks to soaring global oil prices that pad export revenues. A crude makes up most exports and about a third of federal income. Higher prices now deliver clear gains as the Dangote refinery's expansion cuts reliance on fuel imports, unlike the 2022 energy crisis. Yet this boom comes with caveats. A downstream petroleum deregulation lets domestic fuel prices attract global benchmark closely, driving up transport and food costs. Inflation at 15.5% could squeeze household budget, upsetting fiscal windfall and curbing private spending. Fish expects oil-driven government spending and sector investment to balance out weaker consumption, netting modest growth. Meanwhile, regionally, oil importers like Kenya and South Africa face steeper hit from pricier energy and fertilizers, straining current accounts and currencies. Ghana and other West African peers fare better due to lower energy exposure. Fish views impacts as contained if tension eased by late April, with oil prices normalizing afterward. A downside risks loom. A prolonged strife could spike prices further, fueling inflation, currency slides, and instability. Investor caution may also slow portfolio inflows through emerging markets. Similarly, Nigeria has achieved a major fiscal milestone, with non-oil revenue now accounting for 75% of federally collected funds, marking the end of a 14-year dependence on crude oil, according to a March 2026 report by Quarters Economics. And the report showed that a country's revenue structure has shifted dramatically. Tax revenue now contributes 87% of total federal income, while oil shares has dropped to just 27%. This transformation signals a fundamental change in Nigeria's fiscal foundation. According to the report, the country has moved from fragile, oil-dependent revenue to a system largely driven by non-oil and tax sources, reducing vulnerability to global commodity shocks. These reports will form the crux of a conversation this morning, looking at the indices, what these means for Nigeria, first looking at the non-oil revenue increasing in that regard, and also looking at Fitch, a report that projects GDP growth for Nigeria despite struggles with global oil. It would be a conversation, but first we'll go on a quick break, and when we're back, we'll look at all of these reports and research and what the impact is on the Nigerian economy and global economy. Don't go anywhere. Welcome back. Still looking at the world of business and Business 101. My name is Blyden Kim. My guest is standing by. Before I went on that break, we spoke about interesting feature. First being the Fitch report indicating a decline in terms of growth for sub-Saharan Africa. But interestingly, looking at Nigeria's GDP growth and saying Nigeria economy is sort of still growing amid all the concerns at the Strait of Hormuz and the Middle East impacting the world. And similarly, we'll talk about non-oil revenue increasing from a Nigeria's point of view according to Quarters economy. I won't be doing it alone. My guest joins the conversation this morning, Dr. Abel Udi. Dr. Abel Udi is a chartered accountant and a banker, joining to give perspective in this regard. Dr. Abel, good morning. Oh, doctor, I'm adding doctor to you. Mr. Abel, good morning.
Good morning, Blyden. Thank you for having me on your show.
So good to have you join the show with good thoughts you always have. Interestingly, I'm already calling you doctor. Maybe it's time to push it a notch further.
That'll be very soon.
All right, so good to have you join the conversation. Quickly, let's get into the thick of the conversation. First, a talking point we center about a Fitch report. Fitch being a global credit rating agency, has come out to give perspective about the constraint, and that's happened from economic point of view. Sub-Saharan Africa seem to be struggling in terms of the numbers. And when you talk about the numbers, we're referring to what is happening at the Strait of Hormuz and the Middle East affecting Sub-Saharan Africa. And Fitch has shown the March report that the forecast has dropped from 4.3% to 4.2%, but from a Nigeria's point of view, it has indicated a growth rate for Nigeria in that regard. I don't know what you make of the report, but let's start a conversation looking at the state of the Middle East. Interestingly, this morning, as of yesterday, there were talks about a truce and ceasefire. Donald Trump came out and talked about it and made a whole lot of statements, going all bullish about the negotiations alongside the leader of Pakistan. But this morning, we still saw that Iran was still bombing Israel. I don't know what you make about all the concerns of the war and oil prices and on and on and on. Just give perspective before talking about the Fitch report.
Yeah, for me, with the ceasefire broadcast between the U.S. and Iran over the movement of goods and vessels along the Strait of Hormuz, we are looking at, I think the world should expect some stability at least within the 2 weeks of the ceasefire. However, I think regional organizations and the international community should look at ways of ending the faces between Iran, Israel, and the United States, within the shortest possible time. However, I think normalcy and international trade, will resume along the Strait of Hormuz, and it will definitely impact the prices of crude oil within the next 2 weeks.
Struggles within that context and crude oil prices. Let's come back to Nigeria, Sub-Saharan Nigeria and Africa in that regard. Fitch has come out to say that Sub-Saharan growth has slowed down. Looking at the regards of April concern towards the end of April, that the war might continue and it might continue to affect Sub-Saharan Africa, where the growth rate slows down from a projection towards the growth rate slows down from 4.3 to 4.2% in that regard. But one interesting aspect also, how has this really affected Nigeria? Because Fitch rating has also shown indices from a Nigerian point of view, and a projection is that inflation can go up from 12.3% to 15.5%. Mr. Abel, are you there?
Hello?
Mr. Abel Udi, good to have you back for a moment.
I'll be commenting on the report from Fitch Solutions, which projected an outlook of about 4.4% GDP growth for Nigeria, about 100 basis points from its previous projection of 4.3, which is above the African average. The African growth average of 4.2. Well, I think for me, this outlook was predicated on, the current cost of crude oil in the international market, which with Fitch revised his 2026 price upward to 70 barrel, up from $70. And the effect this is going to have on the Nigeria's economy is the fact that we will be expecting, if the war continues, we'll be expecting a windfall in terms of revenue into the federal coffers. And as an oil-producing country, the Dangote refinery has still us the problem of also using this windfall to import highly priced refined petroleum products as against other African countries that would have to pay more for refined petroleum products as petroleum and diesel and even aviation fuel. So our local production capacity has been able to act as a buffer for us in terms of the outward flow of our FX, while we are able to grow our reserves. It places us in good stead to repay creditors' men due and also attract portfolio investment, because when it's a huge reserve, all the portfolio investors will understand that when their portfolio investments are due, it will be easy for the federal government to repay its obligation. So for the Fitch is basing its projection on this net gains. And also, if you look at currently, we've had some institutional reforms in terms of taxation, with the National Revenue Service now being the sole agency for collection of federally collected revenues, shows that the possibility of revenue leakages like we had in the past, has been reduced drastically. And we also have macroeconomic stability in terms of monetary policy, where our MPR rate has stayed within the 26.5 to 27% MPR rate over a longer period of time, thereby trying to curb inflation. So I think the basis for this growth, is edged on the reform in terms of fiscal reforms, the efficiency of NRS, monetary policy stability, and our gains from earning more money due to occasioned by the war, and having not to spend more on importation due to local production by Dangote.
All right, a good perspective there, Mr. Abel Udi. Just adding to this conversation because it could be confusing. You've touched the first part from a Fitch report that says Nigeria's GDP is going higher, rising 4.4% projected compared to 4.3% previously. Let's also talk about the downturn in it, because you've really talked about what is causing a Fitch to give this projection moving higher. All of those reforms and the very fact that crude oil exports at the moment, that prices are high amid the concerns in the Middle East, and Dangote refinery also preventing more importation of gasoline in that regard. But let's talk about the downside of it, because from the macroeconomic point of view, it seems positive, but the macroeconomy is always going to be where all of this plays out. And Fitch has also reported that Nigeria's inflation, which also projects cost of commodities, and now we've mentioned the price of cost of the naira, stability of the naira, also being involved in this part, that inflation will move forward to 15.5% upright from 12.3% it was. So make it make sense to me from economic point of view. GDP seems to be going up in this time and inflation going higher.
Now, for the import, of this growth, the increase in global prices is a fact that we have to expect some form of inflation, because the prices of our local refined products, is determined largely by the fluctuations in international prices. We can see that we already, both of us know that the federal government of Nigeria has removed inflation and removed the subsidy. So the element of subsidy in our petroleum product prices is long in the past. And Dangote, the pricing template is in line, the price of crude oil, is in line with international price of crude oil, less, international, cost of transporting the crude oil to Europe for refining. So we'll see that Dangote still prices petroleum products in line with international price of a barrel per crude. The import of this is that, refined petroleum products being the major driver of transportation costs and also a major driver of power costs for manufacturing companies will mean increased prices, for finished products because transportation and power costs, hugely impact on prices of goods and services, which also will have a triple effect on the ability of the people to buy more. You understand? So while there's the prospect of growth, on the economic front, the individual Nigerian who have to cope with increased prices and reduce consumption, you understand, will drive up inflation. However, we don't expect the war to go on forever. We are looking at a situation where this will be quickly resolved and the prices of refined petroleum products, or price of crude goes down, which also has a ripple effect on local pricing as well.
All right. Looking forward to ripple effects on local prices. We've got to talk about inflation standings and possibilities. What if the war doesn't slow down as fast as possible? What do you make of it from a Nigerian point of view? And the price of petrol in the country are going higher and higher. I mean, all of these concerns. It will be a conversation when we come back from the break. We'll go on a quick break, and when we're back, it would be about non-oil revenues increasing compared to previously what standing was 14 years ago from a Nigeria's federation account. It would be a conversation on the impact of that alongside inflation in the country. Don't go anywhere. We'll be right back. What's happening? What is happening? Okay? What is happening? My mind is okay now. Okay, I'm going to take a little time, maybe 5 more minutes for the next conversation. So pardon me. And welcome back. It's still Business 101. And my name is Bladun Kem, and my guests are still standing by and ready for the talking point around the world of business. And looking at inflation previously within the context of Nigeria, and the Fish report has given indication that sub-Saharan African growth has dropped from 4.3% to 4.2%, a projection in that regard in their March report amid the concerns in the Middle East and the Strait of Hormuz being center of attraction amid the tension. And similarly, from a Nigerian point of view, Fish had said that Nigeria's GDP would experience growth despite the fact that sub-Saharan economies are dropping a bit. Nigeria would be moving a little further from 4.2% or 4.3% or 4.4% in that regard. And Fish also projected struggle for Nigeria in terms of inflation, which Abel Udi gives perspective to it. Inflation would be moving higher to 15.5% from 12.3%. And now let's go to another report then. This time, the quarter's economics are giving ideas about fiscal measures are changing from a Nigeria's point of view, with non-oil revenue are now accounting for 75%. Previously, was a struggle, all dominating proceedings for the Federation's earnings. But now things have changed, and quarter's report is saying non-oil revenue has now increase. Abel, let's start this way. I don't know what you make of it, but part of the conversation from a quarter's economic report is that taxation has increased in that regard, and we're getting to that session where probably the VAT has increased from 5% to 7%, and on and on and on and on. Key factor, taxation, also increasing, but it's all about Nigeria not relying, federal government not relying for funding, relying from oil, as it were. Looking at all the struggles that's happened within the last 14 years, Nigeria depended totally on oil, and things are changing now. I don't know what you make of it. Add perspective to this.
Well, I think my take on increase in non-oil revenue, making about 5% of total federally collected revenue, I think it's a win for Nigeria on the one hand. And at the same time, we also have to look at ways to maximize or improve our oil revenues. It's a win in the stance that it shows that Nigeria is actually really diversified, and we are not, going forward, will not be fully affected by volatility of global oil prices. However, if we look at this, if we drill through this increase, we'll see that VAT, contributes a major part of the growth, and there's been an increase in the rate of VAT from 5, to 7.5%, which is about 50% increase in the rate of VAT collection. The implications of those increase, it also reduced consumption on the part of Nigerian people. Then we should also know that company income tax also forms a major bulk of this increase. So, we can adduce a few reasons to this. One is the fact that the federal government, through its recent tax reforms, has been able to block a lot of leakages, has introduced the e-invoicing for large organizations. It has been able to, and through the Executive Order 9, has been able to ensure that all revenues, are being collected by the Nigerian Revenue Service, to ensure that we don't have multiplicity of agencies collecting revenues, which allows for leakage. And another major factor is also the reclassification, of taxation for some companies. Some companies in the oil and gas sector that either were paying only petroleum profit tax are now being subjected to company income tax. So, which means that, that's for companies that are operating onshore and shallow waters, so they pay a combination of what? Company income tax and petroleum hydrocarbon tax. And there's some other classes of companies that were either under the Petroleum Profit Tax Act that are now classified as doing regular business, majorly companies in the midstream and downstream sectors of the economy. So these factors, contributed, this classification, the tax reform, and the Executive Order 9, have been able to enable the government to, generate more of non-oil revenue than oil revenues. But I am optimistic that oil revenue being a major contributor to our federally collected revenues will increase, and this is anticipated in view of changes in the PIA, which reduced taxation, hydrocarbon tax to about 30%, and company without company income tax, which is a reduction of about 20%, which the government had to do to ensure that we don't be making our deep offshore operations to Namibia and Guyana. You understand? I mean, we are looking at in the short term, we'll be able to attract more investments into deep offshore operations in Nigeria, and we'll be able to get more out of our oil and gas industry.
All right, a fantastic thought there, Abel Udi, giving good perspective regarding what it's all about, where the revenue is coming from when you talk about non-oil revenue to the Federation's account in that regard. We only hope that it's sustainable for Nigeria moving forward, such that commodity shock wouldn't be a factor, just as it is now, where oil prices and global benchmark prices are going higher, and in return affecting Nigeria's oil commodities or derivative of crude oil in the country, such as Jet A1 as well as petrol and diesel in that regard. Thank you very much, Abel Udi, for being a part of the conversation. We're out of time. Thank you.
Thank you so much for having me on your program, Lyden.
Absolutely fantastic. It's basically what it is, what it has to do with reports from global credit agencies, and from a Nigeria's point of view, when the positivity comes, everyone seems happy. We can only hope that it trickles down to the common man and not just a superficial number from macroeconomics. Thank you for being a part of it and joining this day. My name is Blyden Kim, and thank you for watching.